This is the How to MSP podcast. I'm your host, Andrew Moore.
It's not a win-win. M&A is one of those categories. So it's either a win-win or it's a lose-lose. There's not one's a winner, one's a loser. And so if it's not going to be a win for the seller, then it's not going to be a win for the buyer, and neither party should do it.
That was Reed Warren. Reed is the president and CEO of IT Valuations. Reed has over 30 years experience in the technology services space as a certified valuation analyst. Reed has aided in over 90 different transactions across 19 countries, serving over 700 clients. Today, we're honored to have Reed on the show as he talks about what is a multiple? How do you get the most value for MSP? What does it look like when you're trying to sell your company? What do you need to be prepared for? What financial variables make the most impact on the value of your business and allow you to be able to weather financial issues that you find in the market? Reed is full of knowledge and experience, and we're excited to see what he has to say. Good morning, everyone. This is Andrew Moore, and I am here with Reed Warren with IT Valuations, and we are going to be talking today about driving value within your MSP, building a valuable MSP, looking at EBITDA, finding out what makes people want to buy a business, what makes it valuable, how you can get people to invest in your organization. So, hey, Reed, how are you today?
Hey, super glad. And Andrew, thanks so much for having us on the channel here with you guys. Really love what you're building here. Love your background and history, your passion for the market and passion for seeing companies transform, and just grateful to be on that journey with you. I think from that perspective, we're really well aligned. There are so many companies that need help in that transformational journey, and they usually don't think about it until late in the game. And the earlier you start, the better off you are. And so really grateful for the work that you're doing, and it's just really spot on for so many people.
No, I appreciate that. And again, thank you. You're hired. You are now my hype man. I will take you with me on every journey I go on. So thank you. So Reed, where are you today? Where does the podcast find you physically? Where are you at?
Yeah, home in Minneapolis, at least for the time being. And usually I prefer not to be the center point of, the U.S. and what everybody's talking about.
Yeah.
Anyway, so that's where we operate out of. And it's a great place, I think, from that perspective for just running the business. Probably 98% of our client base is outside of Minnesota. So it's a great hub to work from and sort of centrally located. So.
And you are a road warrior of all sorts for the MSP community. So if people haven't seen Reed on the internet, you probably have seen him or his organization at just about every show. So you were just mentioning, so you're at Robin. Yes. Where are you going to be out the next few weeks?
We'll be at TMT or Robin Robbins, the Marketing Toolkit, their Producers Club. That'll be next week in Vegas. We'll be at the PAX 8 peer groups. We just do a lot of work with peer groups, and then also at Evolve, at the Evolve peer group. So those are probably the three peer groups that we're most engaged in. We used to do quite a bit with Taylor Business Group, but then probably less so down the Kaseya channel, although that's been growing, certainly as Robin Robbins has been acquired by Kaseya, and that whole journey has been going on. We just really feel like that's probably the best environment for us to work in, predominantly because MSPs are getting together in those environments to really talk about, hey, what can I do to change my business, how to become a better business. I would just say a lot of what we do is bring objectivity to it. So just real quick on my background, spent the last really 16 years doing valuations, mergers, acquisitions within the IT services market. Now I think pushing through about 105 transactions. That really became the backbone. The transaction work really became the backbone for our valuation work, just simply because we saw that most valuations being done for businesses really weren't capturing what was happening in the transaction. So we really built out our valuation platform to really be able to look at 26 different elements that we see actually in real transactions. So your contract lengths and your customer churn and employee churn and net revenue expansion, all these factors, how they actually they impact the transaction value. I'm going to argue pretty strongly that understanding the value of your business is probably the most important thing you can do as a business owner, because it really directs all your investment into the business. And most of us as owners, and own my own business, and so I fall into the same category. I'm not exempt from many of the things about business. Like I actually have to not only run the business and be the operator and owner of it, but I also really need to look at my business as an investment and how would an investor treat this business, right? And so I do need to look at what's the return on my investment? What is the return on the dollars I keep putting back into IT valuation? And is it really the best investment that I have? And so there's a lot that goes into that when you think about not only how do I drive the value of the business toward an exit, but it's not only just about an exit, it's about how do I make sure that I have something that's really sustainable and profitable. A healthy business is what really provides for me as an owner, but also provides for my whole employee base and my customer base. And so I don't think there's anything wrong with being proud of having a highly profitable business. In the end, what that gives me, everybody on my team, and the same thing for you guys as business owners, is capacity to be able to handle the downturns that are going to happen in the market. We like to think everything's up, but hey, if I'm operating at 5% EBITDA versus 20% EBITDA, boy, it doesn't take much of a downturn if I got 5% EBITDA before I got to start cutting people, cutting staff, making changes because I can't handle a downturn. When I got 20% EBITDA, I can take up to a 20% hit before I actually have to change what I'm doing. And not that I'm saying you don't want to make adjustments before that point. My point is a profitable organization gives you a lot more options and it gives you a lot more flexibility. It allows you to carry through on your commitments to team members and individuals. And then also for what you're trying to do from a long-term exit plan, but also just from an investment. If you want to attract an investor, if you were going to invest your money, you want to invest in a highly performing, highly profitable organization. That's going to give me the best confidence as an investor that this investment vehicle is a good vehicle. So we really feel that from understanding your value is what's going to lead you to making all the right decisions about producing a high value, highly market resilient business.
Right. So let me hop in. I'm gonna dive into a couple of things there because I like the picture that you painted. I have some clients. Some of them are between $3 and $5 million. They're running anywhere between 5 and 15% EBITDA. Why should they care about what the value of their business is today if they're not looking to exit in the next 5 years, right? Should you have a valuation done of your business like every 5 years or just 3 years before exit? Like, what do you tell people about why they should care about valuations of their organizations and what that means?
Yeah, I mean, I think so. We do have a lot of people that are like, "Hey, I'll do this when I get closer to an exit." The reality is, in many ways, I'm going to put it back to the real estate thing. You got a house. You bought a house, and it's like, well, I want to improve the value of the house. What should I be doing? Right? Well, should I add a deck? Should I add another bathroom? Am I going to get a return on the investment? So on our valuation of service, and I'm not here to pitch it, but so much as to say we do it on a quarterly basis. So we'd have companies that would come back. They go, "Hey, I'm thinking about selling." And so we'd start with the valuation and they go, "Oh my gosh, what you're telling me, Reed, is if I change these half a dozen things, I could add $500,000 of value to my business." And the answer is yes, yes, you can. And they'd go away for a year and then they come back a year later and say, "Okay, let's do the valuation again. I think we got that stuff fixed." And they identify some more stuff. And so we got into the rhythm with most of our customers is like, "Hey, it's a quarterly review. And so every quarter we're doing a valuation for you. We're identifying where you at on these 26 different risk factors, but then also really looking at, there's really two elements that drive a valuation, right? How do I change the multiple, which comes to those company specific risk factors? And then how do I change my EBITDA? Because that's what's getting multiplied, right? And so in the end, we're running to look at both of those different elements to say, hey, how do we optimize your profitability of the business? And how do we optimize the multiple of the business? And candidly, for most people, it's easily a 3-year journey to get all those things kind of dialed in and optimized. And so when we think about somebody is contemplating an exit in the next 3 to 5 years, it when we start that journey, there's proof is in the pudding. The pudding's your financials. And so you can talk a lot about all
Right.
the things you want to do and how great your company is. But if I can't see that in your financials, no buyer's going to believe you and no investor's going to believe you. And so when you look at making the changes over time, it really is working through those different elements such that I can see it actually in your financials where you made those strategic decisions as a business. And now that becomes proof that you've actually made the change and the change is actually working effectively. And so from that perspective, we really like to be able to do it quarterly, just because it produces data sets that are relevant. And you can, most people are on a EOS type system. And so it fits into the quarterly rocks. Hey, this quarter, we're going to really work on our contracts. This quarter, we're going to really fix our chart of accounts. this quarter, we're going to do these different pieces. And each of those elements fundamentally increase the value of the business while you improve on the profitability and on the growth of the business. It also gives me the ability, when you when you think about it from a transaction, even from a buy side perspective. So when you map out your trajectory, you're leaving about 50% of your growth on the table if you don't have an acquisitive strategy. Now, most people aren't actually set up to go do acquisitions and acquire companies, but I'm just telling you, when you look at your max growth rate, you have a huge opportunity to be able to go do acquisitions. And again, the only way you can really do acquisitions is you have to have a good understanding of the value of your business, because you're going to need banks if you're going to do debt financing, or an investor if you're going to give them equity to help you do that. And then fundamentally, the seller is going to resemble the buyer in the next 12 to 18 months. And so you need to become a model company for what that seller is going to eventually look like. And so if you're struggling at 5% EBITDA, growing at 5%, you could buy a completely high performing 20% growth, 20% profit MSP. And guess what's going to happen? It's going to look like you. And as much as you may want to capture the good things that they're doing, you as the buyer are going to dictate the structure and the form and eventually the performance of that company. And so the best thing for you to do is to become a top performing company so that you can do acquisitions of suboptimal firms. And guess what? You're the one who gets the benefit lift from actually transforming them from that suboptimal into that optimal firm that you've become as a part of that journey. And so for all of those reasons, it just and we talked about just market resiliency in that sense of just there are upturns and there are downturns in the market, and the high profitable companies are the ones that can best sustain the downturns in the market. And the market's never going to go always up. And so from that perspective, again, a lot of that is just really understanding the different efficiency ratios, the different profitability, just start with some of the fundamentals of accurate gross margin numbers. And I know you do a lot of work with that, Andrew, on the coaching side of it. If I don't know how I'm making my money, I got a really problem on sustaining a profitable business, right?
Yeah, no, for sure. And there's a couple of things I wanted to drill into, just to kind of get the listeners up to speed on some of the terminology, because not everyone who listens may be, completely familiar with some of this stuff. So let's talk about, I'm going to go off script just a tiny bit here, but I think glossary of terms is important because we're talking about finance stuff for a lot of folks who are operators. When you talk about multiples, can you talk a little bit about what that means? Because you're talking about multiple of EBITDA. Are you talking about 1 times trailing on revenue? Like when you're talking about when you go in to see what your company's worth and you're a $5 million MSP at 20%, that means you're dragging $1 million in EBITDA, right? Which is pretty good, right? At 20%. And then you get a multiple of so what does multiple mean? How do you look at that when you say, oh, my company's worth 5 million, but I expect to get 10? What does that even look like?
Yeah. I would say for the most part, MSPs trade on multiples of EBITDA. When a company sells, it sells for X number, right? And let's just say that $5 million firm sells for $7.5 million, right? So 5 million revenue sells for 7.5 million. Well, what is that? Well, people take the revenue, the transaction value divided by the revenue and say, well, they sold for 1.5 times revenue, right? Or if they had $1 million in EBITDA, well, they sold for 7.5 times EBITDA. It's a way for us to do comparative analysis to other transactions, because most people don't want to come out and say, yeah, I sold my $5 million business for $7.5 million. They would rather say, hey, I sold for 7.5 times EBITDA, because it sort of veils the transaction, and it veils how much I actually sort of made on the sale of my business. And so when you get into conversations with owners, they will never tell you what the transaction dollars really were, but they will tell you what the multiple was. And that's on the multiple of the trailing 12 months revenue, or the multiple on the trailing 12 months of EBITDA. The reason why I say it's a bit of a misnomer is valuations actually aren't done that way. So we're not taking your EBITDA and going, well, that's a 5X. And so we're just going to slap that on there, and that's the value of your business. Valuations are really done from a company specific risk profile. So you can have 2 $5 million firms and they have radically different values. So if they're a top quartile firm, that $5 million MSP could easily be worth $7.5, $8 million. And you could, as a top quartile firm, if they're producing, $1 million to $1.2 million in EBITDA, that means there's a lot of stuff they're doing right. Their gross margins, they've got growth rates, so forth. But you can have a similar MSP that's 5 million and not similar, an MSP that's 5 million in revenue, that could easily be worth $1.5 to $2 million because they're just doing everything wrong. And so the difference in those values is not the multiple on EBITDA. The difference in those values has everything to do with the company specific risk. And so what we try to do in the valuation is we define those company specific risk factors and then the impact of that to come up with the value. And then we're going to do a similar thing to that we talked about before. We're going to take that valuation and we're going to divide it now by the revenues and the profitability of the firm to say, hey, this is a comparative multiple back into the business. And so that's where it does get a little bit confusing. But I would typically say when you look at an MSP, as a general rule, they're going to say it trades on multiples of EBITDA. There are some thresholds that you do run into on the revenue side. It's regardless of how profitable you are, it's almost impossible to sell an MSP for more than 2 times revenue. You have to be really big before that really starts to happen.
Right.
Conversely, almost regardless of EBITDA, I could have a $5 million firm that's producing no profitability, trade for, 0.3 to 0.4 times revenue as a minimum. So there's a couple of boundaries there because there'll be people that'll say, well, yeah, that's 5 million in revenue, and I know you're not profitable, and I can buy you for $2 million because I know what I can do with your $5 million of revenue.
Right. When MSPs want to start getting ready to value their business, we talked about this quartile of these top quartile firms. What really gets reviewed in order to determine what is part of that quartile, right? Like you had mentioned EBITDA, but I know we have a lot of other things like revenue mix, and you talked about risk profiles, like potentially like maybe having 1 or 2 giant accounts that are, holding 60% of your total monthly recurring. Like, can you talk a little bit about understanding what gets reviewed as part of that decision to kind of put these companies in different quartiles and how you start to grade against that baseline of multiples that you had just talked about?
Yeah, really good question. Probably the biggest one that people don't really think about and realize, and that is just pure revenue growth, right? Top line growth. Um, and so when you look at it, your growth is your number one. It's the number one lever you have to change the multiple that's applied to your business. None of these things are standalone; they always impact others. But if I have a great sales organization and I suck at delivery, but I can keep growing, I can put 20% top line growth onto the business, regardless of my churn, which may be horrendous. I still have 20% growth and I still have a very viable business that people will pay a premium for because you've been able to sustain growth. And so it's easier to take a growing MSP and make it profitable than it is to take a profitable MSP and make it grow. You can take a growing MSP that has terrible delivery and you can go, well, I can keep that growth growing and fix the delivery issues and I'll even have a better growing firm, right? So your number one driver of value is actually your growth rate. Your second driver of value, we talk about this a lot with the rule of 40, and we'd like to put those together, is your revenue growth as a percentage year over year. So whatever year, if I grew 20% last year, great. And then what's my EBITDA as a percentage of revenue? And EBITDA is earnings before interest, tax, depreciation, amortization. Long thing there. For most MSPs, that's the same thing as your net operating income. So your NOI.
Right.
So if I take your NOI as a percentage, I'm operating at 15% EBITDA or 15% NOI, and I'm growing at 20%. I add that together and I have a factor of 35 on a scale of 40. And so 40 is a theoretical limit. We've tested this. You can Google it. There's a lot out there on it. We've seen it hold up true. That says an operationally efficient organization. So when you talk about an operational efficiency level, it is on this factor of 40. And so it says, hey, I can grow at up to 40% as a completely efficient organization. I can sustain 40% growth indefinitely. However, I'm probably not going to be really profitable. And we have clients that actually do that. They grow pretty consistently 36, 40%, and they struggle to make 5% EBITDA. Conversely, you could have people that are 40% EBITDA, and no surprise, we have clients that do that. It's no surprise. They don't have any growth. And so as a result, those are and you can't lean it out and you can't get any more efficient than that. And so what we like to see is this balance that's going to be, as an investor and as a buyer, as long as you're between 35 and 40, it tells me you have a really efficient organization. So I care less about the growth rate and the profitability, but I care a lot about the blend of those two. So like in one year, you might take 30% growth and 10% profit. I'm like, sweet, that's a very efficient, they're taking market. And then you might have the next year where you're 20 and 20. And then it's like, well, that's cool. You kind of stabilize and balance. And the next year you could be 10% growth and 30% profit. Well, now I know you're harvesting based upon the growth. So it just tells me as a buyer or as an investor that you're running an efficient organization. You're making strategic decisions about whether to harvest or to capture market or to harvest profitability. And each of those things really tells me that you have control on the business. So that rule of 40 is really kind of that second factor. It's obviously very blended with the top line growth. And then similarly, the third one, which goes right along with it, is your reoccurring revenue. And it's not because reoccurring revenue is intrinsically valuable, it's that consistent profitability is very valuable. And so recurring revenue tells me, hey, you have these contracts that are going to effectively guarantee me a certain level of profitability on the business. And so we really do like to see your reoccurring revenue, pushing in that 65 to 70% of your total revenue is recurring. Now, that doesn't mean it's all managed services. It just means between your managed services and your reoccurring product sales, you're getting into that 65 to 70% total monthly recurring revenue.
So when you talk about that 65, 70% against non-recurring, are you also that non-recurring number is project work or it's hardware? Like where does SaaS fit into that? Like where do you guys look at that, your Pax8 bill, your Microsoft bill, where does that go?
Yeah, so a couple of good questions. If I had a 95% reoccurring business, would my multiple possibly be better? And the answer is the multiple, yes, would be better because there's less risk in the organization. However, you would have less EBITDA. And so the reason why we say 65 to 70% on the blend is we know kind of as statistically from looking at top quartile companies, a client is spending $100,000 in reoccurring services and recurring consumption with you. We know for a fact that they're going to spend somewhere between $30,000 and $40,000 a year on projects, and they're going to spend probably $20,000 to $30,000 a year on average on product. What does that translate to? Well, that translates to right around 70% recurring revenue, 20% in projects, and 10% in products. And so when you come to market, and let's just say you dialed it all in and you got to a 95% recurring revenue level, most buyers would look at it and say, hey, you're leaving money on the table here in your customer base. You're missing opportunities on projects and you're missing opportunities on products. And so I just tell you from that perspective, if you're getting up into the place where your recurring revenues are in that 65, 70%, don't try to push your recurring revenues higher. Actually focus on making sure that you're capturing all the opportunity in products and projects, because fundamentally that'll drive more EBITDA than your recurring revenue services probably are. And as a result, you're going to have a higher base now to multiply.
Right. And what I found very fascinating about some of the work that I've seen your team do when they're doing these quarterly reports. And by the way, I ask all my guests not to plug what they do here, but Reed's got this fantastic valuation as a service platform that you can go in and plug your data into, and his team will work with you, and you can look at it in a dashboard and make adjustments and forecast and stuff. And so you can really dig into gut feeling. So we've had clients that I've done the operations coaching side with Reed doing the financial coaching on it, and we've looked at it and they were like, we think we're top heavy. And we looked at the numbers. We're like, you see this particular graph right here, this actually, like, that validates your suspicion. So, I think it's really interesting when you start looking at the different data points that you can put together and how you measure those against this bucket of companies that you've got all of this data on. How important is it when you're starting to look at gross margin in an MSP, because you've got services, you've got tools, you've got a lot of different factors.
Right.
Where do people want to see some of those numbers? How does gross margin play into this roll-up number into EBITDA? And how important is it to this quartile factor that you talk about from a maturity standpoint?
Yeah, really, really good question. So when you think about it, most people's operating expenses are pretty fixed. My rent's my rent, my electric bill is my electric bill, my internet's my internet, right? I can squeeze some of that stuff out, but I really, for the most part, those are just sort of fixed expenses. The place you have the biggest control on is actually your cost of goods sold. And so you should be having all of your labor, direct labor in cost of goods sold. And you really should have broken out by each revenue stream. So I really actually want to know how much of your direct labor is doing time and materials, how much of your labor is actually doing projects, how much of your labor is actually doing managed services, and breaking those out accordingly. Because in the end, that tells me where do we need to fix things, right? So when I look at your managed services gross revenue, um, I'm looking at not only how much are you charging the customer, I'm looking at also how much is it costing you from a product and tool set, and how much is it costing you on the labor side to be able to deliver those services. And so from there, we're going to take that in and say, hey, as we look at all these companies that are now in our database, we do know for a fact that top quartile firms are able to get 55 or 50 to 55% gross margins on their managed services. Well, we're going to take a look at yours, your situation. If you're at 45, and this is Andrew, where you come in on it so much, it's like, okay, so we're at 45. How do we change that? Maybe you just need to simply go get 5% more in a rate increase. And that's the easiest way to fix that problem. Otherwise, it may be we're actually overpaying our staff and we should look at right sizing our staff, or our tool set's too expensive. So until you actually have really articulate cost of goods sold lines where you can see from that revenue stream, what is my cost on products? What is my cost on labor? If it's all lumped together, I don't have the dials to know where it is that I'm making money and where it is that I'm losing money. And so part of the reason for breaking out the labor into each of those different categories is too often what happens is people just put it all into one and say, well, they mostly do managed services and then do some project and then do some other stuff. Well, when you do it that way, I can't tell if you're actually pricing your projects right. And I can't actually
Right.
tell if you're pricing your time and materials right. And so by breaking those pieces out, I can actually see where it is that you're losing money or not making money, or where you make, candidly, if you're priced too high, you're also putting your customers at risk because they're going to, man, I'm not getting a lot of return on that value. Really going through and understanding your gross margins for each of your revenue streams is really good. So at a high level, I like to see 50 to 55% gross margin on your managed services. If I'm looking at kind of that, I'm going to call it SaaS category, which could be Microsoft 365 or some of those other tools that I'm selling. The reality is nobody's leaving you to get M365 somewhere else cheaper. I mean, you just can't, right? But I would expect on those I would say on that kind of Office 365 kind of category, we're seeing typically in that 18, 19% gross margin. On the broader SaaS, which could include some hosting and some other tool sets you're providing, we typically see closer to 29%, between 28, 29, 30% gross margins on kind of that SaaS category. Hardware, pretty tough to get much higher than about 25%. But if you're not
Right.
getting 20%, you need to look at raising your rates on that. People aren't buying products from you to compete with Amazon. They're buying it because you can actually go implement and go execute on this, right? So you may just need to raise your rates or just change your markup on your product side of things.
So let me drill into that for a second, and this is where I might sound dumb. So just try
No,
to make me not sound dumb. But I always in my primitive finance mind, I would always tell my team at 20% on hardware because of SG&A, we were basically paying the client to buy hardware for them, right? Like, 'cause if you're not pulling down 20% gross on that, once you factor in SG&A, if you're at 22%, you're at a negative
right,
2% on those dollars, right?
right.
Does that sound right to you?
Yeah, I would say that seems a little high to me, but it's not. I'd rather have you make more money than less money. um,
Right.
from that perspective. But I would truly say, I mean, a lot of people are like, well, I just take their product. If it's $1,000 laptop, I mark it at 20% and I sell it for $1,200. Yeah, that's not going to work because by the time you figure your cost on the data, like if you're using financing to buy it, when you look at your cost of your time associated with helping your customer choose that, when you look at all of those factors, yeah, if you're not getting 20%, you're probably really not. I would argue that it's probably closer to 15%. So if you're selling at a 20% markup, it's costing you 15% to actually go acquire it, procure it, deliver it, ship it, all those other aspects. 5% markup, you should quit doing it, right? And so you really need to be in that 22. We do see some people that can get up towards closer to 29 percent markup on their hardware, and they've just gotten aggressive with it, and they just say this is what it is. But I would say a lot of
Right.
our clients are actually just simply saying it's our product, we're not supporting your product. And so just from an efficiency perspective, most of our clients are defining for for the end customer, here's the 3 laptops you can buy. Here's the server you can buy, or 2 servers. You can choose any one of those. I don't care which one. We'll support it. But if it's not one of those, we're not supporting it.
I think a lot of people feel like in order to get that margin on product, you have to go and charge your client more. And I always remind them that there's another lever you can pull, which is to get the product from a less expensive source. And that could come back to, you could go back to your vendor. And if you open a line of credit, maybe they're going to give you an extra 2% or 3% on purchases. If you buy in bulk and deal reg something so you can keep some inventory for standard assets, you could do that. You could even go as far as using HAWS as an option, maybe not for FRU type, like field replaceable assets like laptops, but you could certainly do it for firewalls and switch infrastructure and things like that. So there are other ways of being able to move that needle without just gouging your client, right? And still staying market competitive when it comes to pricing, right?
Yeah, but at the same time, yeah, I totally agree with you. And at the same time, I would say you as an MSP, you struggle with the rate increase more than your clients do. And the biggest barrier to actually getting a rate increase isn't your clients. It's actually you being confident enough to say, no, this is a fair value exchange. I should be getting this amount of money. Doesn't matter who you are. Every end customer will always be happy to get it cheaper. And they're never going to come to you and say, you know what, you should be really charging me 10% more for these services. They'll never come to you and say that. The reality is almost all of them will take a 10% increase and they'll never leave you because of the value that you're providing. And so the barrier is more in you as the MSP owner than it really is in the customer. And I would just say we've seen, particularly through 24, where we had such high inflation, we had clients that were going and sometimes getting 5% rate increases twice a year just to keep up with inflationary fact. They didn't actually have any customer churn, or the customer churn was so incredibly low, they still were money ahead by going after and asking for the rate increases. And so you just need to be good about getting rate increases. So when we talk about those drivers of value, one of the, it's like fifth on the list is net revenue expansion. So you should be getting, when you take a look at your existing customer base, you should be getting somewhere between 8 and 10% growth out of your existing customer base. Now, 5% of that growth is going to be just getting 5% rate increases, and 3 to 5% of that growth on top of that should be cross-selling, upselling, and selling them new services or upgrading them to a new service, right? So ideally, you should be getting automatically, without selling a single new logo, pretty close to 10% organic growth just in your existing customer base. From there, ideally, you'd love to be getting, 5 to 10% top line growth. If you're investing 5 to 7% in sales and marketing, I think the sweet spot is closer to 10 to 12 personally, but you really want to track that return on investment because that translates into new organic or new logos being put on your board through organic growth.
Yeah. And I've talked to my clients quite a bit about, in my opinion, once you get to a certain size, and I usually like to do this $4 or $5 million, do it at 3, but $4 or $5 million. One of the very first things I talk about is trying to find account management as a dedicated person to be built into a department, because at that point you've got the owner and the operations manager and just people who are generally like running around doing 6 different jobs. If you have somebody that can protect your revenue, right, focus on reduction of churn, making sure that you're staying sticky, selling those projects, talk about cross-sell, upsell, that frees up the owner to work on additional new logo sales and continue to stay laddered within the account, right? Be their executive sponsor. You don't want them to completely step out. But the way that I see it is when you look at how I've seen the more successful MSPs grow, they begin to develop those relationships at an account management level, which opens up the service manager to be the service manager, the owner to be the sales lead, right? Some real opportunity for the organization to grow their existing base as well as pick up new logo opportunities.
Well, and I'll just tell you, I'll say this about myself because this is true for me. Arlen Sorensen was where I heard it from, and I just laughed because it was so true of me too. Arlen said, best thing I ever did was quit selling. Because Arlen was always the one that gave discounts, and the reality was probably one of the best things that happened for IT Valuation is Reed quit selling. Not that I'm not a part of the sales process, but everybody, because they knew he was like, Reed, can you just like give me a discount on this? And I'm like, yeah, sure, no problem, and that sales team's going, kind of WTF, man, why why'd you give them a discount, right? And where my team actually would have the boldness and confidence to go and say, no, this is fair market value for what we're doing. We're going to provide this set of services. This is a fair return. It's a fair exchange, right? And so I just share that. I share that with you guys that so many times us as owners always feel like, hey, we've actually got it because they know me. We should give them some sort of discount. And I would just say most of your sales team or your account managers, no, they're incentivized not to give discounts,
Right.
right? And as a
Right.
result, they give a whole lot less. But in the end, let your sales team be the sales team. Let them negotiate the price. They're going to negotiate it better than you in that sense. But the customer will still feel like, hey, I've got a good relationship. As we go through kind of a owner-led sales, that doesn't mean that the owner is actually establishing the pricing. I actually find that it's best that the owner not do that and really trust
Right.
the account management team and the sales team to actually do that portion of the sales journey.
Yeah, when we would sell it, we would let the salesperson, we as executives, myself or one of the other owners of the MSPs I work for, we would always be there and support the salesperson through that journey and help make sure that we've established a relationship, introducing the account manager as soon as we possibly could. And then we would step back and let the salesperson do what they were paid to do. And there's a couple of reasons for that. To your point, we are just excited to make a sale as anyone. And since we're where the buck stops, we're a lot more inclined to be like, okay, cool. Like, let's just get this across the finish line. You let the salesperson do it. And the salesperson has somebody that they have like the boogeyman in the background. They said, well, I got to go take that to the owner. And
Right.
then they'd come back and then we'd have a conversation about it. So then we would allow them to try to drive that forward and say, well, let's not, give without getting. Like, we can take that out, but, to lower the price. And that was always super helpful for the sales team. And we wound up having a much happier client because the sales team was able to explain the value of what we did versus us just going in and creating a discount to get the contract. Right.
Right. Totally agree.
So,
Yeah.
yeah, I always thought that was really, really an important part of what we were doing. One of the things I do want to talk about, so we've talked a lot about the numbers, and let's talk about the stuff that that as we go through the valuation process, and this may come into kind of more of on the due diligence side, I guess, as you pass into transaction. But as a person getting ready to put together a world-class business to drive the value, whether they're exiting or not, what specific things do they need to be preparing in the background outside of the books? Right. So we've talked a little bit about how you want to break up your books and about how you want to see things in the accounting. Talk to me about things like contracts. Talk to me of things like they
Yep.
have old partnerships and people who've invested in their business. They've got operational documentation, insurance. Like, what do people need to be doing in order to help manage these risks in order to really understand the value of their organization? What do you
Yeah.
recommend?
Yeah. Really good question. Cause there's a lot outside the financials that happen. So I would say, first of all, one of the things that, when we look at so when we launch a sell side project, we do an M&A readiness assessment is really what we do. And it's, yes, the financial piece is a very, very critical one to it. It's probably sort of the cornerstone for a lot of it. But when you look at those other risk factors that we're trying to capture, probably the second one that's going to come in really close behind is I'm going to call it legal. And legal is a really broad category, right? So this is going through and actually really going through all your customer agreements and what's assignable, what's not assignable, what are the liabilities. Every
Can you double
buyer,
click on that real quick? It talked about
yeah,
what assignability is, because it's
sure,
something that I've heard come up a lot over the last couple of years, and I want to make sure everybody's clear about assignability on contracts.
yeah. So there's actually two factors: consents and assignments, two different things. So consent is this: you can't sell the business or have material change of ownership without a customer's consent. And so that now means the customer has to be drug into the conversation before you can actually sell the business. And so consent is a really huge issue that's there. Customers want that because they don't want you to sell the business and they don't want the disruption. And so they want to know about it before you can actually pull it off. And so one of the things when you draft your agreements, make sure that you draft it so that there's not consents. That's probably the biggest things. Now, a lot of your larger customers are going to try to push you to do that. And you need to take a firm stand and just say, we're not doing that. I want the ability to be able to operate the business, and we're going to run the business without your consent. I don't see as much consent issues today because most customers, except for there's some categories, like if you're doing a lot of work within the government or within municipalities, they sort of require that. You're just going to have to tackle that as you go through it. But I would say it's becoming less and less of a factor. Probably the other one is called assignments. You can't assign this contract to somebody else without getting approval from the customer. So where that's happened, what's happening there is I can't outsource it, or if I sell my business, I can't assign this contract to the buyer. And so one of the things that you really want to go through, assignment verbiage is really common within most people's MSAs. And so one of the things you want to take a look at as you get ready to sell, and this is where when we talk about taking 2 to 3 years to get ready to sell, this is some of the stuff why it takes 2 to 3 years, because you'll review your contracts and it won't be your standard contract. It's going to be all your contracts because seriously, every time we sell a business, they're like, our contracts are fine. And then we go through it and we find out that they've got 20 contracts. And it's what there's some of their biggest clients who have assignment clauses and consent clauses. And you're like, well, you now can't sell the business without notifying them, or you have to go change the contract with them. And so it takes time to change contracts. So what we typically like to do, especially if you're going to be selling in a couple of years, you'll do a full contract review on your vendor or on your customer contracts. And you can say, hey, we're just cleaning up all the stuff. We're going to force all of our customers to sign new contracts with us because it's an annual recurring piece. And so, as a result, we can now upgrade all of those contracts in a timely fashion without creating some sort of unusual event that people start going, I wonder if they're selling, right?
Right.
And so that's a piece to it. The other one is I would say your operational contracts. So this is your owner's agreement, especially if you have minority shareholders. That's another place that we see a lot of baggage. It's like, well, I had a partner and 25 years ago, I bought him out. But do you have any paperwork to show that you actually bought him out? It's like, well, no, I paid him, here's a receipt for $60,000 or whatever it is I paid him. Well, technically, if it's not there, he's still part owner in this piece. And we
Yeah.
see a lot of baggage like that where, or I lost the contract, or I lost the agreement, or I didn't have it. And so just going through a complete kind of operational legal review, just looking at your own operating agreement, making sure everything's clean there. And even so, not trying to get anybody divorced here, but there's oftentimes where the operating agreement doesn't deal with spouses. And so if you had a divorce, um, there still may be rights where the divorced individual still has rights to their equity portion if they're a common law
Mhm.
state. We run into that here in Minnesota. There are just a lot of pieces there that can really easy to get screwed up. And then as a result, they're now part of the transaction. You're giving away a piece of the business as a result. So good operating agreements. And then vendor agreements is also the one that this is a little bit harder because you have to, sign kind of what a lot of these big vendors are going to force you to sign, but just really knowing where they're all at, making sure that you have them all there. It's an element of scrutiny. That's vendor agreements. And then you're going to get into some of the operating. So this would be leases and loans and things like that. And there's usually a lot of baggage buried in there. We had, as an example, we had somebody who bought the building they were in, but it used to be a gas station. And so now you had EPA issues because, there was
Nice.
gasoline on the site. And so there's just a lot of stuff like that you just never would think would happen
Yeah.
um, that is buried there. And it's all going to come up as a part of due diligence. And so really going through a comprehensive legal review in advance of that so that you can have time to fix that before going to market.
Yeah, and then things like too, like any employee agreement contracts,
Yes.
anything that could like raise some sort of risk for the organization. Like you could
Yes.
have something where somebody worked for you 10 years ago, and the documentation wasn't quite where it needed to be. That I remember in some of our due diligence that came up. They were like, "Explain to me who this person was and why are they no longer here? We don't
Right.
have a termination notice from them or something." And we're like, "That person hadn't worked here in like 11 years," and they asked the question, right?
Right.
Like there's a lot of that I remember happening. It was
Well,
crazy.
and on that, which is super important, especially if you develop. So, a couple things. We do a lot of R&D studies, so research and development studies for tax credits. So, anytime you're doing process improvement, automation, leveraging AI, you can get an R&D tax credit as a part of that. Highly recommend you have that reviewed. It's sort of free money for you. You've already paid the taxes. So you can go back up until July of this year. You can go back to 22, 23, and 24 and refile if you've been doing any process improvement. So you're just looking at those internal projects that you're working on. If you switched from ConnectWise to Kaseya or vice versa, or you decided to use IT glue, anything that you spent on that from an internal perspective can be used as R&D. Where I'm going with that is, hey, that's intellectual property. So unless you have a statement within your employee contract that the work that's the employee's done is work for hire and you own the rights to everything they develop, that's a good thing. A lot of people don't have that in there. And so now what happens is if I built any sort of automated process that I can now charge a customer and I go to sell my business and the guy, had done a lot of the development from it, he actually could claim that has rights to that product or that automation that he's built that now needs to be paid to him as a result of the transaction. So,
Right.
we've had a lot of those times where even in employee agreements, the buyers come back and said, hey, before we're actually going to buy this, you need to go through and actually get intellectual property rights assignments from all your employees. And you might as well just tell our employees you're selling the business, because that's the only reason why you asked that. You
Yeah.
just, again, that's one of those things a year to 2 years in advance. You just like, hey, we're going through some corporate hygiene here. We want to standardize these pieces. Um, and I would say with that, we see so much, not only the intellectual property rights assignment, but we do see a lot of stuff where it's like, hey, they've been employed for 20 years and never really had a contract. Yeah, that can be a problem, because then you can have an employee claim that I wasn't fairly paid or there was all sorts of issues. And so again, good corporate hygiene is going to tell you that you need to stay on top of these agreements. You need to have, every time somebody gets a raise or their job title changes, they really should have a revised employee agreement. Employee handbooks should be signed every year so that they're in change, any of those changes are happening. There's just a lot of that stuff that normally you don't think about until you actually go into a transaction. So that legal side is just, when we talk about legal as one of the elements, yes, it's
Right.
a really big element, and that's just one part of it. And then there's plenty of others that you're going to need to look at from an insurance perspective. There's a whole bunch of insurance stuff, particularly around D&O insurance. People oftentimes don't have, and it's being more and more required. Obviously, cybersecurity, and you're going to have to go through all those policy kind of transitions. Usually, that's one of the last things before close, and almost every time there's insurance related stuff. And then the other one that usually bites is liens against the business. And so the unfortunate reality is sort of anybody can do it. And so anytime borrow money, they can put a lien against the business. It's not a surprise. But what becomes surprising is all the little stuff that you never thought about that suddenly, can be there, and it will hold up the transaction. So you might have had and we see this probably more with Chase. I'm not trying to complain about Chase banks, but you might have had a loan with Chase and you closed the loan 5 years ago. And however, they never took the lien off the business for the loan. And even though the loan's been paid and the loan is set at zero, and it might even be in the records that that there's zero money owed, the reality is they have a lien against the business. You can't sell the business until that lien is cleared. And so then if you go work with Chase 3 days before close day, you got to get this lien release. It's like a 2-week process for Chase. And so it's just one of those things you need to take a look at, do a lien search on the business before you do it. We've seen crazy stuff there from, hey, somebody bought a lawn tractor and put it on their corporate card, but there was a lien because the card on the business. We've seen, my favorite was a guy ran a toll booth in a company car. And so the state actually put a lien against the company vehicle, because he hadn't paid the fine for running the toll booth. And it was only like $240. But we literally couldn't sell the business because a buyer is going to require that there are no liens against the business. And so we're running around trying to figure out how in the world with the state of Texas do we
Right.
pay a 8-year-old, uh, toll booth fine for $240 so we can get a lien release, right? So there's all sorts of crazy stuff that happens like that, but that's something else that you do want to take a look at, and you could head off, certainly early by going through and doing it.
Yeah. And it sounds to me like it just comes back to this, right? Everything that I've heard you say, everything that I've been talking to my guest about over the last few months is surprise, surprise, if you want to run a business that is profitable, that is valuable, that is not going to have your hair on fire all the time. I mean, we are in the IT services space, right? It comes back to being consistent and deliberate. And as you begin to baseline things, let's just say today I woke up and I want to be a more stable MSP. And so I'm going to go get all of my client contracts and I'm going to start reconciling them. Well, that doesn't really do you a lot of good if you don't create a process or amend your process to say, and now every time I get a new contract, I'm going to keep a copy in my operational database and I'm going to keep a copy in my data room, like my folder that I keep all of my information in. And so you have to go through the process of being deliberate and focused on it. And whether that's a quarterly review of the finances and an annual review of the data repository that you're keeping and stuff. So I think that it sounds to me like we really want to encourage people that this is not a one and done, or this isn't, hey, let's start doing this 6 months before you decide to sell. This is, again, minimum 3 years. But if you really want to run a business, maybe get one of these valuations done, go through the process of understanding what that looks like, and then create some consistency so that when the time comes, the forklift isn't dramatic, right? And you know what you're going to be getting.
Right.
It's not going to be a surprise.
Well, and I would just say, I mean, it's sort of when you think about the journey from going to market to letter of intent to due diligence to legal proceedings and to close, I would equate it to it is very much a marathon. Can you run 26 miles? Well, I could maybe walk 26 miles and I'd be in a world of hurt, right? And so when you think whether you like it or not, once you start that journey, it's a marathon. And candidly, the more you condition beforehand, the more you prepare ahead of time, you can run that. The point I'm trying to make with that is the more you can prepare, the better off you're going to be. One of the things you just touched on, I just want to reiterate because it's really foundational, is most sellers don't want their team to know that they're selling their business, right? They want to keep it in the dark. The problem is if you haven't prepared ahead of time, there's almost no way to keep it a secret because you're going to start asking for a bunch of stuff that everybody's going, why are you asking that? You never asked for that before. Why are you worried about it now? And so what we talk about, when we talk about that kind of corporate hygiene, we do want to get to the place actually when we start that journey that just says, hey, we want to run this business efficiently. We want to run it correctly. We want to have all these legal reviews. We're going to create a repository or effectively a data room. And we're going to keep our financials there. We're going to keep all our contracts there. We're going to keep all our engagements there. We're going to keep all our employee agreements there. We're going to keep all the stuff you need for due diligence. But now I have my team just used to like, hey, every month the financial team puts up the next set of financials. And every time the sales team closes a new agreement, they update the agreements in this folder. And so now everybody's in the rhythm of keeping all the data that you need for a transaction up in a place. It's always current. You then don't have to ask any unusual questions. You just like, hey, can you guys make sure that that section's updated, right? For the different pieces that they contribute towards it. So everything from payroll reports to, like I said, agreements to operating agreements to vendor agreements to financials to sales pipeline. Even, hey, we have a repository of all our processes that we use for running the business. It should be in a standardized spot. It should be kept current. So you get the whole company accustomed to documenting, accustomed to uploading it to a central location. And now, quite candidly, you have a complete data room that's available for an investor. If you need to bring an investor, if you need to show a bank because you want to borrow money to be able to do acquisitions or other things with the business, it's all ready. It's all there. It's all available. You want to sell the business, it's ready. It's there. It's available. And nobody in your team is going, boy, why did he ask for that?
Right. And I will say this, having lived through this process a couple of different times with MSPs, it is an intensive process for the seller. And as an owner who might be integrated into the business heavily, you will be required to be extracted from some of the day-to-day simply because of the amount of effort that you have to put in. It could be nothing one day. It could be 6 hours. It could be phone calls. It could be legal reviews. It could be contract explanation. So I will say that if possible, one of the things that I would strongly recommend is making sure that you're developing line of succession as an owner. We talked about it early in the episode today, where you and I talked about, getting a great account manager, finding a good salesperson, being more of a manager of people and allowing those people to do their jobs at a high level from a maturity standpoint. Because when it comes to the sale of your business, you're gonna get sidelined from some of the day-to-day stuff. And even if you can keep up with some of it, the amount of effort you put in after hours is going to be crippling to you to make decisions during the day to run your business. So having a good second lieutenant, having good people that work underneath you in order to keep the business running through that process, I feel has been invaluable for the companies I've seen that were able to do that. And the ones that didn't, it became apparent to the other people that the boss was acting weird and stuff was going on and nobody knew. And so it became really unpleasant. Like it wound up creating, I think, some churn within the organization from a personnel standpoint. Rumors started floating around, and it just got to the point where it went from being a really neat event for everybody to being this unpleasant thing because everybody was slammed and they didn't realize what they were getting into, right?
Well, there and truly, when we look at it, and you're just exactly right on that. So it's another risk factor. It's owner dependency. How dependent is the business on you as the owner to be able to operate as a going concern? And the more dependent it is on you, the less valuable your business is, and the harder it is for you to be able to sell it. And so, on that point, bringing up a team from an hours perspective, when you go into the pre-letter of intent all the way through close, you should expect to be putting probably at least 20 hours a week into the sale of your business. So we encourage people to go get to the place where you've delegated, you got your team managing it, you're actually running on 20 hours a week. So you can now handle 20 hours a week of due diligence and all the related sales stuff, and you're not killing yourself. But I'll tell you this, doesn't matter how many hours a week you're doing, you will put another 20 hours a week easily into the sale of your business. So if you're running 60 hours a week, guess what? You're going to be nearly killing yourself just to get through all those different pieces on that. And you're going to be working nights, weekends, whatever it takes to get it done. And candidly, uh, M&A journey from letter of intent to close, speed is probably the most critical factor, because the longer you take, the more questions everybody's going to ask. And so if you give an investor 6 months to ask questions, the investor will take 6 months and ask you questions and then ask for updates on those questions every month that goes by. Where if you can actually go from letter of intent to close, and a good buyer will do that in 2 months, well, yes, it's a race, but it's only 2 months long, not 6 months long. And so how well you have your data together and how well you've delegated down to your team to be able to run the organization without you, is a huge element, not only to the success of the transaction, but just for your sanity and just the pressures upon you as you go through the journey. So owner dependency, we talk about it. You want to get to the place where you can take a 6-week vacation from the business and everything runs fine. When you can do that, you're probably in a place of pretty low owner dependency. And that's candidly one of the most valuable positions for the business from an owner dependency perspective.
Well, and I think it's a great place to wrap up the conversation before we get into our questions here is that every owner, I hope, is looking for a business that is valuable, that is fun, that they get to do the stuff that they enjoy doing. They're not killing themselves. It's running on their own. And so, everything that we've talked about today, and then all the things that we've been working on with the channel, in the MSP community is how do you create an accountable company that functions with structure and metrics and clear deliverables and outcomes for the employees and the clients. And if you're able to start implementing some frameworks around that, you'll get to build a company that's valuable. You'll get to take your time as an owner to do the things that are important to you and to be a part of what goes on in the channel or to spend your time in the ways that you want to. And oh, by the way, when it comes time to make an exit from your business, it's not going to be a shock to your system and you know what to expect and have the time to do it. So,
Absolutely.
Reed, I want to thank you so much for being on the show today and taking the time to talk to us. This has been incredibly helpful for me to understand more about what goes into valuations and how the folks that are listening to us can make better decisions about the value of their company. So I appreciate your time.
Oh, it's great. This is a fun conversation, and yeah, grateful to be on with you.
Awesome. All right. So let's ask a few quick questions here. I'm asking 5 questions. Right. What's the best business book that you've ever read that helped you? Hands
Um,
down, what's the best one?
so actually, buy back your time. That's been personally probably one of the most effective ones. The second one that's a close one. So that's really more of a personal thing. How do I manage my time? And then the one right behind it would be managing a professional services firm.
Oh, okay. Okay.
Uh,
Well, and for those who are listening, I will look those up and put them in links into the show notes. But yeah, that's awesome. Okay. That's really, really good.
the third one,
All
I
right.
find one more on a third one because this
Okay.
one's probably better for the Simple Numbers by Greg Crabtree. You want to, so much of actually what we built, a lot of those pieces came from him. We didn't get a chance to talk about labor efficiency ratios. Really, really, really good when it comes to around those gross margins that we're talking about is actually, am I getting the most out of my direct labor? And am I getting the most out of my management labor? Two real important numbers you look at, but he's a great book. If you followed his metrics, you'd run an incredibly healthy organization.
I've heard a lot about labor efficiency and looking at those numbers, and that's become kind of, I'm not going to say it's the new buzzwords, but I'm hearing it more and more and more as I'm out coaching with our clients, which is people are really focused on utilization and labor efficiency. And that's a kind of a big deal, especially in a services company. So,
Yes.
um, love that. Okay. If you had to say a bad word, which in fairness, I don't think I've ever heard Reed say a curse word. Like
Yeah.
he's like it, and
I did
Jason
say
and I were
shit
having,
on the show, so you may have to edit that out. But
yeah,
no,
yeah.
I'm
So,
not a guy who swears a lot, but I will drop an F bomb every once in a while.
okay.
But it's pretty high on the pressure load before I'm
Yeah.
doing that. So,
That's fair. And that's, so you know me, I'm a little salty. I try not to offend people with my language, but, I pepper it in different things. I have another guest who likes to pepper in, but I'm finding more and more people who are just like, listen, especially leaders, I've noticed a lot of leaders are just like, I'm not going to use a word unless I absolutely intend it to be used. I mean, other than getting, hitting
yeah.
yourself with a hammer, right? Like but like when you're in a mixed group of people, folks are going to keep that kind of at a very high
Well, I
level.
did
So I
hear an
appreciate
interesting
that.
statistic on that though. That if you sprinkle in some curse words and some language, people tend to perceive you as more truthful. So,
Interesting.
and I think that's actually I think there's an element of truth to that, honestly.
Yeah.
Whereas, like, hey, that just shows kind of a raw, authentic individual, and therefore I'm more confident in you than somebody who's always has a smooth, right answer,
Yeah.
never gets ruffled. And so, anyways,
No,
so and maybe I need
I
to
like that.
sprinkle more of that in. So,
No, no, no. You be you. I love that you're you like that. It keeps me straight because if I weren't around folks like you and Jason more, I would sound like a sailor like all the time. So it's super helpful. Okay. So band or music artist, which one is your favorite? Like who are you going to see? What is the one that like you're not feeling great, but you got to put that album on? Who's your favorite band? Who's your favorite artist?
I like Lindsay Sterling.
Okay.
If
Who's
there's
Lindsay Sterling?
Lindsay
I'm not
Sterling,
familiar.
she's electric violin, and
Oh,
she's got a ton of stuff out there. If I'm
okay.
looking to actually focus, work hard, I need some good adrenaline pumping music, I will listen to Lindsay Sterling.
Okay, Lindsay Sterling. We will also link to something for her so that anybody can check her out. That's awesome. What is the note? And you don't have to use names unless you really want to. What's the worst sales call or meeting or personnel meeting that you've ever had? Like the one where you just are like, it's terrible and it's hilarious and it's awful, and you just had this call and you met with a client or you met with somebody and it was just not great.
Worst one, yes. And hopefully I'll try to keep this short. So we're representing the buyer on the situation, and we got to the day before close. Everything had been negotiated. The the buyer came to me and said, "Hey, um, we need to buy this company, and we have to make sure it gets done today. But we need to have them leave their $400,000 of excess capital, or their excess cash in the business because we can't make payroll." To which I had to say, "You shouldn't buy this company if you can't make payroll." And they're like, "No, we actually need you to go tell the seller that we're going to redo our agreement so that they leave the extra $400,000 in the business so that when we buy them today, we can actually make payroll in 4 days." And that, so I said, "Well, look, I will do that for you, but I'm also going to tell you, and I'm going to tell them the same thing. Neither of you guys should do this transaction." So I did. I went to the seller and I said, "You're not going to believe this." And they're like, "Believe what?" And I said, I told them, "Here's the situation. and you should not do this. Now, the mistake the seller made is the seller had the buyer to their office. They had already announced the transaction, even though it hadn't gotten done. And the seller was like, after swearing at me for 20 minutes, said, what the fuck? I can't back this thing out. So we're going to go ahead and do that. And so he gave up $400,000 of cash to close the deal so that the buyer could actually make payroll. And surprise of all surprises, the deal fell apart. I mean, 6 months later, they were trying to unwind the whole thing. So anyways, that was the probably the worst set of meetings, calls I have ever been a part of. And I can't believe that either one of them actually had the audacity to ask for it and actually had the sanity or insanity to actually do that. So
wow, so just to like kind of poke back to like our previous conversations, something that shocks me is that, and the statistic I've heard banted around is like 90%, but I don't know that it's that high. Like a lot of deals that people are really like, they're going to get them done, they fall apart right at the last minute. Like not all, once you go down, even after LOI, like how many deals, like, I mean, what would you give it? 50%, 70%, 80%? Like how many deals just don't make it across the finish line?
I would say, I would say most of the ones that we do, but that's because we kill it pretty quick if it's not going to get done. And this was one of the ones that was late in the game, and I would argue pretty strongly, and I did tell both of them should do it. I firmly believe neither party should have done it, but both of them felt too tied into it. But I would say it's probably close to 20 to 25% actually don't get done as a part of that journey. But I would say there's a lot that get done that shouldn't get done, and a lot of it similar to this situation. It's been such a long journey. It's been such an emotional journey. You're so sick and tired by the time you get to the end that you're just like, kind of WTF, just do it. Let's just get it done with. How bad is it going to be? And if you're saying that, you shouldn't be doing that.
Yeah.
And so I would just say as an advisor, we work really hard and we've gotten harder on this to say, you know what? You guys shouldn't do this deal. If it's not a win-win, M&A is one of those categories. So it's either a win-win or it's a lose-lose. There's not one's a winner, one's a loser. And so if it's not going to be a win for the seller, then it's not going to be a win for the buyer, and neither party should do it. And so we really try to be very careful on our sell side process, that we're making sure we're walking a really good process, but we're helping to intervene with seller fatigue and buyer fatigue. We talk about it: fear, uncertainty, doubt, and greed. Those are the 4 elements that happen in every transaction, and just making sure that people are in the end making the right decision and not just making a decision to be done.
Right.
Yeah.
Well, and that's helpful because I think, especially for your business, you don't want to get a reputation as, well, you used to call it a puppy mill, right? You're like, I'm just going to rock transactions, and if they fall apart, they fall apart, right? You'll get a reputation of, you're like you're the Scott Boras of the MSP space. Like, you're going to get people money, but at what cost, right? Like, what damage does it do to the market, to the reputations of the people involved?
Yeah. We like to count the transactions 1 year later when both parties said it was a good deal.
Yeah. I love that.
So,
all right. Last question. Who needs to be on the podcast, that like a person, like who do you think would be really good for me to interview that I haven't talked to yet? Do you got somebody?
Really good. There's probably, I'm going to start with one. I would definitely put a lawyer, either a Nate Nelson or Beth Schroeder, 2 attorneys that we work with quite a bit, but just actually talking through the legal elements of it. They both do a lot in the managed services MSP space as transaction attorneys. Nathan's a tax attorney as well, and so can just kind of address those issues. And so I would just say that's one of those things that people talk to their attorney last, and in many ways you should talk to your attorney first. It'll save you money. So
yeah, no, I will definitely get some contact information and see if I can't get the invite over to them and get something recorded, because definitely legal is on my list of topics to cover over the next few weeks and months. So I want to get something put together so people can learn from that too.
Awesome.
Cool. Well, Reed, try to not freeze, I guess.
That's right. It's going to be 20 below here next couple of days. So yeah, we'll just.
What do you do like when it's 20 below? Like, how do you even manage your house? Like,
Well,
That's insane.
the same thing people in Arizona do when it's 120 degrees outside. So,
Yeah, stay
and
inside.
you stay inside and you make sure
Yeah.
the heat runs. And yeah,
Down here in Texas, it's going to be like 15, and they've declared a state emergency, and they're shutting everything down, and everybody's encouraged to go get gas and extra food and batteries. And so I don't know. We'll see what happens.
Minnesota, they're nothing like that. It just, that's what happens every winter. So
Yeah, they're like, yeah, suck it up, Buttercup.
Don't lick any flagpoles. That's all I can say.
Great advice, Reed. All right, well, I appreciate your time, and I thank you for being here.
All right, awesome. So grateful for it. Thank you.